Thank you very much. I really appreciate it. My name is James Brunger. I run sales and distribution, among a few other things, for a firm called Capital Square. I'll get into us here in just a second. I do want to just segue with a couple things that Andy said. Opportunity zones. We've been at the forefront. We started our first opportunity zones in 2018 after the original legislation was passed. They are created under the idea of getting capital into undercapitalized communities. We are so proud of the work we've done here, regardless of the direct benefit, in being able, in our case, to namely provide housing to undercapitalized communities, really core of what we do. Also, echoing something Jimmy and Andy were saying, this is a once in a generational tax savings opportunity. Opportunity zones are still completely overlooked. So for all of you on the call, congratulations, you're ahead of the curve. I hope you learned something throughout the day. And obviously, I'd love to tell you a little bit more about me, my firm, and what we do. With that being said, I'm going to kind of get into the presentation here a little bit, and then we're going to do some fun as well. I got two different programs for you. I'll tell you a little bit more about Capital Square and then get into those programs and keep it rolling. Capital Square, we're about 127 employee firm based out of Richmond, Virginia, with offices in Washington, D.C., Newport Beach, California, founded in 2012. Our founder, co-CEO, is a gentleman by the name of Lewis Rogers, big inside of the tax advantage real estate world. He is mainly known for syndicating his first 1031 exchange as a real estate lawyer in 1986 and really never looked back since. So we're founded under the idea of finding tax saving opportunities in real estate investments for our investors. Very fortunate to over $7 billion of total real estate transacted, 135 different investment programs, 160 real estate assets, more than 6,000, almost approaching 7,000 investors. So we have size, we have scale. To give you a little bit more about us, specifically on the development team, and I'll back up, we are a fully integrated, diversified real estate investment company that focuses on tax advantage real estate investments. 1031 DST programs, that's where we started the firm. As I said, 2018 being tax advantage real estate investments. Opportunity zones came perfectly for us. Couldn't have come at a better time since we were diversifying our business. And so opportunity zones are something personally, I've been at the forefront of it. I've been involved. And then most importantly, our development team and our investment team really has focused in on this. And we've had some great success, which I'll highlight here. A couple of the players at the top of the firm, but really a deep bench overall. The team itself, again, on the investment side is about 30 individuals. On the development team, about 12 individuals with a ton of experience. Since our first funds were funded and our first development started in 2019, we have actually about 680 million of total development value now. Need to update the slide. And we've delivered 3 and now 4 of our opportunity zone funds. At Capital Square, we focus mainly on single property, single asset, ground up opportunity zone investments. We do that for clarity of vision and underwriting, so you as investors know exactly what you are investing in, where the potential risks are. Please review all of the risks, and where some of the potential benefit is. It's worked very well for us, and the reason why is because on non-blind pools, you should have confidence going into the investment. Our investments generally carry a low minimum of $100,000 with some exceptions below that. So we allow you, your investment professional, to be able to determine what the best allocations based on your risk tolerance, market selection, and to Andy's point, the fun you would like to have in making some of these investments. Specifically, this is a highlight of the 7 funds, and I'm going to also introduce our 8th fund. So far, we've delivered Fund 1, Fund 2, Fund 3. 1 and 2 are 100% leased up. Both of these have had a cash out refinance feature. I'll get into more detail here in a second, and are producing quarterly distributions to our investors today. Fund 3 will have that happen by the end upon stabilization, likely by the end of 2023. The project is fully delivered and in lease up today. Our fourth project is a hotel in Charleston, South Carolina. You can see by this rendering, an excellent project. Fund 5 is another very large multifamily project, currently in lease up with a ribbon cutting coming in May. And then our 6th opportunity zone is a ground up 20-story residential tower in downtown Raleigh, North Carolina, that is vertical and getting out of the ground. The first 6 of our funds are fully committed, under construction, and have no room for additional capital. I just wanted to show you a little bit about our scale. The 7th fund is one that I'm here to talk to you about today, which is our West Marshall project in our headquarter hometown of Richmond, Virginia. So to tell you a little bit more about one of our projects that we have available for investment today, it's our 7th Opportunity Zone Fund, as I've said. I want to give you a little bit of kind of the visual, if you will. And as you can see, really our goal here, this is a formerly industrial neighborhood. It's called Scott's Addition. Our goal is to have projects that add a really high level of design, and in addition to that, really fit into the neighborhood. So a little bit of some appeal to the old industrial, but obviously with very modern and great features. One thing I'll point out specifically on real estate opportunity zone funds, real estate opportunity zone funds, you have your return in two areas. We currently have about 14,000 apartments in our overall portfolio, including our stabilized portfolio. The vast majority of our $7 billion or so in assets, about 80%, are housing core stabilized product that we manage. And that is really located in the southeastern US. So core markets like this in Richmond, Virginia. My point on opportunity zones is you have to be, number one, a very good developer. You have to develop great properties and great projects. But number two, you also have to be a good operator. And the reason why is these projects aren't build and sell. They're build, hold, manage, and maximize return over at least a 10-year hold time frame. So the opportunity zones for us really fit well at the core of who we are, since we do manage and have managed for a number of years a number of properties, specifically in the multifamily and housing space. A little bit more rendering here, but overall, to give you more scale on this property, so the Opportunity Zone Fund 7, we launched this last year on the capital raise. The total offering size is $63 million of equity, $100,000 minimum investment, and again, some exception there, $1,000 per unit. This is only open to accredited investors. Our loan to value on stabilization is estimated to be at 65%. We do have construction financing that will close in early June. We're looking closer at about 56%, but we have gotten great bids and great rates there. There is a 7% preferred return, cumulative compounded annually. So our hurdle rate after your investment of a 7, and then investment splits of an 80-20 beyond that. So that puts the investor very clearly a return potential that we need to meet. The reason why we have a good preferred return for those of you who haven't invested in these types of structures, it incentivizes us to return as much cash as possible to you, get that 7% above cash flow, or try to. And then in addition to that, with that 80-20 split of investment profit above a 7, it incentivizes us as a manager to maximize the sale potential. Since that's where we're going to make most of our money, we're directly and completely aligned with our investors under this structure. We are going to hold this for a 10-year minimum from the date of our last investor, which we expect to close out sometime in July or August based on current trajectory of raise. We have closed $39 million of total equity. Any of you on the call who have invested in this project, thank you so much. Really appreciate it. So we've got about 24 million or so to go, and we are averaging about $1.5 million to $2 million a week. So one thing that I want to just point out before I go too far down the road, I know the market has had turmoil. There still are capital gains. That's why you're on the call. I know most of you know this, but opportunity zones being overlooked being available for capital gain, there are still capital gains in a choppy or market like we have today. What we've seen is it's primarily business owners who are selling for very large gains with very low basis. So the idea of deferring tax through an opportunity zone and then completely eliminating the gain beyond 10 years is very attractive. Please, if you haven't looked in really good detail to some of the information provided by Opportunity DB, please dig in deep. This is something that's completely overlooked, to Andy's point, and I really feel that there are a lot of people who could benefit knowing what opportunity zones can do for them. Backing up on this project, we have been very active in the Scotts Addition neighborhood of Richmond. Again, this is our home city. We have about 4,000 apartment units that are stabilized that we manage and own on behalf of our investors throughout the greater Richmond area. We are the #1 buyer of multifamily for 4 years in a row in Central Virginia, all the way out to Virginia Beach. We've been very active here. We know this market well. And then as you can see by our first, second, third opportunity zone, fifth opportunity zone, we're very active specifically in this neighborhood. The fund we're talking about today, Opportunity Zone 7, sits right here. In Fund 1, 2, and 3, we have broken our own record on the rent per square foot. So this market and what we're delivering here has been extremely well received by the tenant base. Giving you just a little bit more about Richmond, it's 1.5 million people in the total MSA, growing at about 1% a year. It's the #1 city for people fleeing the Washington, D.C. area, looking for more affordable living. And then frankly, we're building exactly to what they want and the quality they like. Some of the key strengths you can see here at $2.51 a square foot or $1,700 a unit. That's what we're experiencing today. And that's just in line with our underwriting on this project when we look to deliver. Part of what you see, just to give you some updates specifically on the submarket of Scotts Addition, this is why we like the market so much. On Yardi projections, independent third party, you see a 98% occupancy view, 97.6 over the next 10 years. Although there is some supply, namely we are creating, the reality is demand continues to be a view of outstripping that supply. Realized forecasts and then realized future forecasts, these numbers remain quite strong. One other reason, and this is probably the biggest reason why we like single asset opportunity zone funds like this, is clarity of delivery. Why? Our goal, and I mentioned this before on our earlier opportunity zones, is to stabilize and provide a cash out tax-free refinance to our investors, targeting between 40 and 60% of the original equity you invest. We do that when we move from a construction loan to a permanent fixed rate finance loan, generally at stabilization, which takes about 12 months or so, especially a 350 unit project after delivery of the program. You can see here we're targeting a completion, 24 months of construction schedule. Groundbreaking is on April 17th. And we've already started some infrastructure. So this project is live and is currently under preliminary construction. And then what you can see is our goal is to deliver, refinance sometime in Q2, Q3 of 26, well before your tax due on April of 27 through your deferral. And again, our goal is to hold this to 10 years from the date of the last investor. Why do you invest in a project like this today? Be a quote unquote early investor. Number one, we have a 7% preferred compounded annual return that starts on the date of your investment. And number two, you have 180 days from the date of your gain to make your investment to qualify for an opportunity zone. So there's a couple things there. Perpetual, it's not a perpetual vehicle. It is a closed-end vehicle. We will cut off the fundraise on that project. Again, Opportunity Fund 7. To highlight one other program for you in the remaining few minutes, I'm going to go through this relatively quickly, but we recently launched this, a ground-up multifamily development in Knoxville, Tennessee. Knoxville is the home of the University of Tennessee. It has about a 900,000 person MSA. It's definitely a secondary market in Tennessee, but we have been the number one buyer of multifamily in Chattanooga for 2 years in a row, and we've been very active in the Knoxville market. Unique things to this development. Number one, it's going to be a beautiful 348 unit multifamily project. There are 35 units with an income restriction to qualify. Those units, in exchange for those units being income qualified for 10 years, it gives us the city has provided us with 6.5 million of TIF grant or equity. As you can see, this project is going to be constructed to the best quality possible, condo quality. Again, a 10-year hold. We are in a joint venture with Live Partners on this. Live Development is somebody we bought from and worked with in the past. They build exceptional programs. We are the JV here, so we will have our hands on the construction management. This is a $46 million raise. We did recently open this offering. It has an 8% preferred return with an 80-20 split. A couple unique things to it is that it is right on the Tennessee River, just across from the University of Tennessee Neyland Stadium. This is going to be something that really changes some of the market. This is not a student housing focus, but the reality is the large base of students at the University of Tennessee have put a massive strain on housing throughout the city of Knoxville. This is unique in the fact that the construction loan is in place. We are at 61% loan to cost. We are on a 48-month term for that construction loan and at very good rates of SOFR plus 285. The GMP, guaranteed maximum price contract with Southern Development Corp, is in place. This project is going live and will be breaking ground in the middle of April with a groundbreaking in early May. We're a little bit behind on getting our groundbreaking done on it, but you can see here by the location, this is exactly where it's located. University of Tennessee Stadium directly across the river, downtown Knoxville right up here. There is a footbridge directly south of our area, of our property, that the city has already put the money aside and will start construction with the delivery of 2026. That is exactly about the same time we will be leasing up this property. So a total return here, or a total raise of 46 million. We're about $1.7 million in. Again, we just opened the fundraising after closing the land in January. A couple other big talking points. As I said, the guaranteed maximum price loan is signed. Contract is signed. TIF proceeds, so 6.5 million on the equity stack guaranteed by the city. The loan is in place. The income restriction rents, those roll off at 10 years. I've never seen that from any project I've ever worked on. Please contact us about these two projects. They're really exciting. As you can see, we provide you with the single asset view on our properties simply because we want you to take into consideration exactly what you're investing in. And for us, it's all about providing housing and housing deprived communities throughout that opportunity zone program. So Jimmy, I think I've got less than a minute left. I covered a lot of ground, hopefully kicked us off very well. But that being said, you want to throw one question in the minute I got, or do you am I over already?
No, you're fine. Actually, we got, I sandbagged you a little bit, James. We got a few more minutes. Let's take a deep breath. We've got quite a few questions coming in. I'll get to Bob's question first. He was the first one to submit one related to your presentation, James. Bob asks, does Capital Square perform the development, or are you guys relying on local development partners?
It's a great question. A little bit of a combination of both, Bob. In Richmond, we are the development head and the lead, oftentimes not taking a co-JV or a co-developer. In Knoxville, we are a co-developer on that project. I would say about 80% of our projects, we are the sole developer, and about 20% will look for JV in certain markets. In this case, this is just a JV that we bought a lot of properties from Live. They're an excellent developer. We're thrilled to be partnered with them. We have to have a relationship before we would enter into a JV, just on knowing kind of who they are and them knowing who we are. But a great question. Thanks for asking.
Yeah, thanks, Bob. Thanks for joining us today too. Brad has several questions. I'm gonna get to Brad's first question first, and then we'll come back to him if we have more time. He wants you to discuss on the 7% pref that you mentioned, is capital return before the 80-20 promote?
Yes, it is.
And then he also asks, is there an entrance fee? I'm sorry, an entrance or exit fee paid to the sponsor?
Well, as said, there is a construction finance fee or a construction fee. There's a development fee that goes along with any of our projects. That's true of any development project that you're going to see. There is an asset management fee, generally running at 1% across most of our projects. And then you have obviously the 80-20 split on a profit above. To just give you some high level on our performance numbers, we're generally in the low to high teens on our IRR targets, with 10-year equity multiples somewhere between 2.3 and 2.7, 2.8. So, really attractive. Those numbers are net of all fees on our projection. And again, past performance does not dictate future performance, but we provide every piece of underwriting as to why we think we will perform there inside of our offering documents, our PPM. So certainly stuff to dig in a little bit deeper than OZ pitch day.
Good stuff, James. Bo wants to know about distributions. When will distributions begin? And don't you have to wait to build it and occupy it to create distributions?
That is correct. You're absolutely correct. So to review again, let me get to my timeline. Oh, come on. There you go. Right. Here's a good timeline. This is the timeline on OZ7. And each of our projects are different. Okay. I want to be clear. This is why we do it. We want you to have confidence knowing what likely will happen. So OZ7, we're groundbreaking next month, really June. So in 2 months, we'll finish construction sometime in Q1 of 25. We'll pre-lease in Q4 of 24. And then we're going to give ourselves all the way till about Q2 of 26 to fully stabilize. Once fully stabilized, we expect to move from a variable rate construction loan, which is true of pretty much every development, and then go to a refinance feature targeting 40 to 60% of your original investment on in return tax-free, and then quarterly distributions thereafter, obviously depending on how the property performs. Ideally, that would go up over time if we have rental or NOI inflation. But that big thing for you is that refinance feature after stabilization taking about 12 to 14 months on a 350 unit project after it is completed. Good question. You would have no cash flow up until the refinance and then starting quarterly distributions as it's earning.
Excellent, James. We've got time for one more question. We'll get back to Brad here. He wants to know, how is the sponsor handling any cost overruns? And he also asks, what is the development fee and is it on hard costs only? We got 1 minute, James.
Yeah, it's generally on hard costs. And what I mean by that is, you're going to see it range, and some of it depends on the complexity of the project. Oftentimes it's about 3%. So I would say 3% is a good number there for you. Again, 1% on our asset management fee while we're running the program. All of the fees are completely outlined in our PPM, including and not only obviously our projection, but our yield on costs, our projections on our full land costs, land basis, financing costs, every piece of underwriting you could possibly want to get to. So I would just defer any real detailed questions to the overall costs to be in there. If you've ever invested in development real estate, you're going to see it's directly in line with every single program you've ever seen. We are building with institutional builders as well. So, it's really kind of in line with what we do across the entire spectrum.
Awesome, James. Can you flash your contact information one more time? How can people reach out to you if they're interested in learning more, or if they have? We didn't get to all the questions either, so I would love to give everyone a way to reach out to you if they have questions.
No problem. Actually, it looks like my contact slide was deleted off of this. Sorry about that. CapitalSQ.com. So CapitalSQ.com. Simply feel free to Google Capital Square Real Estate, Capital Square 1031. You'll find us. Capital Square Richmond. You'll find us. On every offering, you see my direct cell phone and contact number, which sometimes can lead to me not calling back immediately. So please give me a little bit of time. Again, we have a team of 125 employees. On the sales and distribution side, I manage a team of over 20 people. Team members will be back with any of the questions. I see there's a number of additional questions, Jimmy. I'm sure you guys will send them to me.
We will.
Enjoy the rest of pitch day. Hopefully this was a little bit of fun. And you guys, good luck on the rest of the day here.
Thanks, James. I'll post your contact info and your website in the chat in a minute here. Thank you, James. Appreciate it.
Sounds great. Thank you.